I want to tell you about a few acts which have been recently enacted and in force for the past 1 or 2 years. The first one being is the Financial Institutions Act, Miscellaneous Amendments Act 2024, which has partially come into force with effect from 30th of August 2024. This is nothing but takes into account the earlier 6 acts which have been in force, and they are Insurance Act, Securities and Futures Act, Financial Services and Markets Act, Financial Advisors Act, Payment Services Act, Trust Companies Act. If you're going to do any financial related activities and you need a license, in India, you go to RBI. In Singapore, it is Monetary Authority of Singapore, which also gives the license, monitor them in their operations. What is the purpose of introducing the Financial Institution Act? Is that to have harmonize and enhance mass investigative and supervisory powers, partially in force because of the act has come in partially across all the above 6 acts which I've mentioned earlier to you. Say, for example, if you look at if you look at the CMS license, Capital Market Service license, which has been issued by Monetary Authority of Singapore, and you know pretty well now the Bitcoin is very frequently used by most of the people now. And if these people, if any of the corporate, the Capital Market Service license people going to operate them by getting into any derivatives in other exchanges outside Singapore in order to monitor them and then streamline them and put them into the risk, what the risk they are getting involved. The reason which the Monetary Authority has come out with the to improve the supervision and get into investigation to see that the compliance is done well by all the license holders. When all these acts have come in, the Financial Institution Act was introduced in 2024 to supervise and monitor them effectively. The second act, the second one which I wanted to get into and inform you about is about family offices, which is being talked much about in Singapore. What is a family office? I have talked to you earlier about family offices in the past and even spoke on that topic. The family office is nothing but if a person has got $1 or $2 million, he tried to manage himself. If the person has got $10, $15 million, he may try to engage private bankers. There are a lot of private bankers in Singapore, which most of the private bankers are 100, 150 years old. They are mainly from Switzerland. They have operations throughout the world. They are established for more than 200 years. Traditionally, they manage the funds of various people in making investments and advising them on various type of investments available globally. And then you pay the fees for the services rendered. And if the people have got more money, like 50 million, 100 million and more, they start thinking of setting up their own family offices. Once you set up a family office on your own, naturally you will engage a lawyer to be involved, to go through the documentation, and you engage an accountant to manage all these investments and then account it for them properly. Then the family owners may be involved in the managing of these funds. Also, they may engage outsource professionals to advise them and pay them the fees for the services rendered, like going to fund managers to advise them on various types of funds which are available globally for them to make investments. Usually, typically, the family offices in Singapore, they set up 2 companies. There are more than 2,000 family offices have been established in Singapore. What is the purpose of setting up 2 companies for a family office? One company will manage all the investments. A second company, which usually is a private limited company, second company, the promoters will be there. The promoters will be there. What the promoters will do is that they manage the investments. When it goes to Monetary Authority of Singapore, no license is issued for a single family office because you are going to manage your own funds. The best is to get a tax exemption letter from the Monetary Authority of Singapore. What is important is that when you get a tax exemption certificate, you don't need any other license. No supervision is made by any other government department, including Monetary Authority of Singapore. But they will be monitoring for compliance requirements. Now, coming back to the family office, when they have got why they take a tax exemption certificate from Monetary Authority of Singapore, the reason is if you do make all the investments in Singapore, any of these financial instruments, income tax department doesn't tax individuals, even non-residents are not taxed. But when it comes to do the same in a company, it is considered as a business for which a new family office regulations have come in. The Section 13OU are all applied for the sake of getting the tax exemption. What is the advantage of family office is that, one, you get a tax exemption. If the company, say, makes $10 million, you will end up paying like $1.7 million tax if it is subject to tax, the corporate tax being 17%. But what happens is you will not be paying the tax. Reason is that you got the exemption. What are the other advantages of having a family office is that it's an estate planning, succession planning, so that, if anything happens to you, it passes on to the family members who happen to be sometimes maybe the directors and shareholders in the company. They don't have to do anything except continue to carry on the business of investment through the company. And so if you are involved in philanthropical activities, that also can be continued by the family members. So succession planning, estate planning is very comfortable through a family office. Management is also easy. The company can hold, if you're going to hold investments in shares and bonds and equities, you can do it through the company. If you're going to own properties in other parts of the world like Dubai, London, and New York, it's easy for you to hold through your company. Now, this family office concept is also catching like forest fire. It is also been, Hong Kong is also promoting family offices. In Singapore, they are talking about $20 million required basically to request for a tax exemption and to run a family office in Singapore. If you want to pay the tax, there is no quantum of the amount you should have. To get tax exemption under 13O, you need to have a minimum of $20 million of investment. 10 million is required at the time of making the application. Within the second year, you bring in the balance of $10 million. What is very important is that under the 13O and new regulations, tax exemption, you continue to maintain the $20 million, and when it comes to you is $50 million continuously throughout the life of the fund when they have given you the tax exemption. Means if there is a, due to fair value calculation, if the 20 million has become 18 million, you have to make good the $2 million to continue to enjoy the tax benefit. Now I go into the third act which has come in, which is called Variable Capital Companies Act. What is the purpose of setting up a new Companies Act called Variable Capital Companies Act when the Companies Act is already available in Singapore. The purpose is that Variable Companies Act talks about most of the regulations, like including shareholders, directors, duties, responsibilities, are in line with what is stated in the Companies Act. Variable Companies Act is like previously when fund managers were managing the fund, they were setting up funds in other parts of the world. Also tried to get to apply to the monetary authority to get a fund management license, which was difficult to get unless you were a bank or a financial institution or a company or an institution which has got established operations globally. Now today, through a variable capital companies, funds can be managed through a company established in Singapore. So when you establish a fund, you may have various funds for carrying out various different investment objectives. In that situation, what happens is that if you want to liquidate any one of the fund, you can do it. You are not liquidating the capital, you are liquidating a fund. So the Variable Capital Companies Act was introduced to have a different set of regulations, which it will not go along with the Companies Act regulations. What is the other advantage of Variable Capital Companies Act is that you can also pool the fund from various people. If you want to invest in startup companies or if you want to invest in various type of securities, bonds and futures, based on the requirements and expectations of the people who have funded you into the variable capital company, the investments can be tailored and suit to the requirements of the investors. Again, under 13O and U, you can go to the tax department to get a tax exemption and enjoy the tax benefits for a variable capital companies. Very interesting because of the promotion of variable capital companies, family offices. The fund managed in Singapore has gone up to $4.7 trillion. Singapore is considered as the third largest fund management. Asset under management is 4.7 billion. Singapore is the third largest fund management companies in the world. If you look up at London and New York, and also the fourth largest forex centers in the world, after also you take into account Hong Kong into the list. Now I move on to the next new act which has come in, which is Payment Services Act. You know, most of the banking services have come into the Payment Service Act because I will give you an example. If small companies, if you want to promote a company under the Payment Services Act, get a license from the Monetary Authority of Singapore. And then if you want to start fundings for SMEs, which are not being served by banks or underserved by banks, these type of companies pool their resources of money and then start investing in SMEs. These type of companies also issue credit cards, do the digital tokens involvement, investment, also provide you with not only credit cards, loans, and also make investments for you in various type of private equities, venture capital companies, and so on. So there are two types of licenses are issued by the Monetary Authority of Singapore. One is standard payment institution license. The other one is major payment institution license, including money change. Previously, there was a Money Change Act was there, which was repealed and merged with Payment Services Act. When I was telling you there are 8 different types of licenses are issued, including remittance licenses and money change license are issued under the Payment Services Act. So as auditors, when you're going to do an audit, you have to keep in mind about the Payment Services Act rules and regulations to carry out your audit. In our office, I have created a special audit programs for companies which are formed under the Payment Services Act, companies which are formed under the earlier act, which was talking about Variable Capital Companies Act, and also family offices. A separate audit programs have been constructed to enable you to carry out the audit in line with all these respective acts and regulations. The fifth act, which I'm going to talk about recently, which has not been come into force, but the act has been passed in Parliament, waiting for the minister to gazette it to announce the date on which it will come into force. It's called Corporate Service Providers Act. This act has been enacted because most of the companies in Singapore are incorporated by corporate service providers. They also provide the resident directors or nominee directors required under the Companies Act to set up companies. They also provide the register office address. They also come in as nominee directors, provide corporate secretarial services, also handle their bank accounts, and also do bookkeeping services for them. In some cases, they also do business process outsourcing and administrative services. Taking into account a corporate service provider role is very important. They do not want to have money laundering activities to happen. They should not be part of these money laundering activities, nor involved to discipline them and to have a good corporate governance. The government has introduced Corporate Service Providers Act. So because of the Corporate Providers Act, which has not come into force, but it's been passed in Parliament, waiting that implementation may take any time, I want to highlight few of the important points which has come up in the Corporate Service Providers Act. Penalties have been heavy. The penalties are heavy. In Singapore, there are more than 3,000 corporate service providers are there. The various acts have been amended, like the Companies Act, Limited Partnership Act, and then LLP Act has been amended to accommodate the Corporate Service Providers Act, which has come into force. And it requires presently all the corporate service providers, I was talking about more than 3,000 are there. They have been, they are also getting licenses as of today. They have to write an examination, which the examination is concerned with the ethics and money laundering regulations and what are the pitfalls which you have to look into. So after they write the examination, pass the examination, and attend the course for the money laundering courses, they also get the license. But in future, if you are involved in doing bookkeeping, if you are going to be involved in providing any other corporate services, like if you're going to do accounting services, going to do internal audit services, management accounting services, taxation services, you are required to get a corporate service provider's license to carry on these activities. So the Corporate Service Providers Act may come into force anytime. The regulations have to be complied with the corporate service providers in Singapore. Now I move on to the contents of the today's topic. The first one is about OECD and definition of multinational enterprises. You are all aware that the Organization of Economic Cooperation and Development is a body consists of more than 140 countries who have become members of the Organization of Economic Cooperation and Development, and also G20 is also supporting and want to be in line with the OECD's way of doing things. They have come out with two most of the countries are having taxation rules because of now e-commerce also has come in, and also each country's tax for various reasons, and then the percentage of tax differs from country to country. In order to have a uniform way of tax so that the multinational corporations doesn't enjoy the benefit of setting up their operations in a country which is a very low tax, and also operate in various countries but doesn't pay a fair amount of tax. With that in mind, the OECD has come out with Pillar 1 and Pillar 2. Pillar 1, and there are 15-point action plan has been come out by OECD countries. The intention is that the 15 points is relating to finance, tax, and all other issues. But OECD has got a bigger mandate for all the 140 members of the country because it is economic and development of the respective country member countries. So one part of it is about taxation and also regularizing on the and related terrorism financing activities, which I'm going to touch upon later. So in order to make the multinational enterprises to pay a fair share of tax, they have come out with regulations which you are going to look into. They have very clearly defined what is a multinational company, a company which has got $750 million of business global turnover in the consolidated financial statements, and they also look into the past 4 years, out of which 2 years, fiscal years, immediately preceding the testing financial year, so the current year is not considered for calculation. When you talk about consolidated revenue of $750 million, it also look into to exclude the minority holdings, exclude also intercompany accounts. And then, as I told you earlier, they also calculate out of the past 4 years, the current year is not taken into account. 2 years, if they cross more than 750 million, is defined as a multinational enterprise. Now I talk to you about FATF, which is Financial Action Task Force. This is also another body. Both OECD and FATF sits in the same office in Paris. Also represent intergovernment of various countries. The intention is also, this is mainly FATF is to combat money laundering, combat financing of terrorism activities, and proliferation. Proliferation is nothing but investing in mass destruction of arms and ammunition. So the intention uniformly, all these member countries, FATF has got more than 40 members. Some of them who are members of OECD may be members of FATF also. All of them, their intention is to have a uniformity in thinking, in avoiding money laundering, financing of terrorism, and stopping them from manufacturing of mass destruction of weapons. Before that, I would like to tell you who changes, what are the FATF has done. The FATF has come out with white list, grey list, and black list for various countries in the world. White list consists of most of the countries who comply all the regulations which the FATF has come out with. So like Singapore, most of the countries in Europe, Australia, Japan, Korea, US, UK, all these countries come into the white list. So when any banks or institutions or companies deal with this type of companies or banks and institution, you are in the white list. So the compliance requirements are fulfilled in these countries, so you do not have to worry or fear. The gray list and the black list, you have to be very, very careful. So you should have they have come out with various process and systems. I will brief you about all those things. The know your customer is very important, and also they talk about customer due diligence. They ask you to go through to verify the individual customers whom you're going to accept, either to form a company in Singapore or to provide auditing or related services. You go through and find out whether these know your customer have clean records to make you to accept them as your customers and carry on to continue to provide service. When you do the KYC requirements, which is customer due diligence, they are requesting you to do on a yearly basis to see that the records of your customers are clean and are free from any fraudulent activities. Enhanced customer due diligence is also expected of you for those clients who come from grey list countries. The list is also available in OECD website. White list, grey list. Black list is all you should avoid in dealing with them, like countries which have been sanctioned by the United Nations, like North Korea, countries like Iran and Myanmar. So sanctions have been made to Iran and Myanmar. So you have to be careful in dealing with this type of people. And if you avoid, it is good for you because the compliance requirements will be fulfilled. It is also required for you to have companies to have internal policies, procedures, and control to look into the KYC, CDD, and enhanced CDD, which I was talking about. Some of them may be politically involved, so politically exposed persons also have to be monitored. And then when you have a PEP people, politically exposed people, it is also required for you to have a continuous monitoring of these people to see that you are free from the compliance requirements. Even when the company should have internal policies and procedures control, as I was talking about IPPC. IPPC also should have a clean staff recruitment process and procedures where not only you monitor your staff at the time of recruitment and continuous monitoring is required also. And also they are also required to keep information of the organization. So you have to light out the policies, process, and procedures for them to act with. The OECD and the Financial Action Task Force has come out with EP 100 and EP 200, which also promoted by the Society of Accountants in all the countries, which basically talks about the professional conduct and ethics of accountants, which is EP 100, and EP 200 talks about anti-money laundering, countering the financing of terrorism, and also proliferation, which are all briefed for professional accountants to comply with. The accountants have also been informed and guided and assisted by these EP 100 and 200 to report suspicious transaction to the suspicious transaction reporting office in the format which has been issued to them. So all these regulations, if you're going to comply with, it is easy to combat money laundering, terrorism financing, and proliferation activities. In Singapore, they also enacted a law called Precious Stones and Precious Metals Prevention of Money Laundering, Terrorism Financing, and Proliferation Financing Act in Singapore. So companies which are engaged in precious metal and precious stones, and even if you have watches, which more than 50% is consist of precious stones, and in which case you need a license to deal with all these type of products, precious metals and precious stones, and the Ministry of Law is issuing the license for which you have to make an application. Subsequent to making the application, you have to comply with all the rules and regulations of Precious Stones and Precious Metals Act. Very interestingly, I want to tell you, under the Act, if you're going to deal with any of the customers, I'm talking about the traders who got the license to carry on this business. If any of you is going to do business of more than 20,000 in cash, you have to report to the Suspicious Transaction Reporting Office. If the same day, if the transaction is split into two, if the total crosses $20,000, that Act is very clear to say that you have to report to the Suspicious Transaction Reporting Office. Even the precious stones and semi-precious metals dealing companies should have what all the compliance requirements I was talking about earlier, about IPPC, know your customer, risk assessment, staff recruitment regulations, all have to be fulfilled. Now I am moving into the next issue is about FATF, which has come out with 40 recommendations and also talks about allocation of taxing rights on corporate profits. The base BEPS one was base erosion and profit shifting. I was talking to you, the multinational corporations or putting up companies in low tax countries and carry on business globally and pay low tax in the world. In order to have a uniformity of taxation, the under 140 countries consist of OECD has come out with a regulation of Pillar 2, which talks about minimum corporate tax rate of 15% for multinational enterprises. Pillar 1 talks about country by country reporting. What is the purpose of country by country reporting? If you're going to report country by country, and if you file this return to the respective countries where the multinational corporations or carry on business, it is very clear for them to understand what is the business done in that country, what are the expenses incurred in that country, what is the profit made in that country, and then what is the tax paid in that country, which will be very visibly available to make the country to have a fair judgment of the contribution of tax made by the multinational enterprise. I will show you the form which has to be filed for this Pillar 1, which is base erosion and profit shifting. By filling up this form, you are going to tell them how much you spend on various type of activities in that country and also the tax paid in that country. This will enable the country to question the M&E that you have done a $2 billion of business. I'll give you an example. You have done a $2 billion of business. You have made a profit of only 50,000, and paid taxes for this? Is it fair? And ask more questions based on the information furnished under the country by country reporting. Australia has raised taxes on various companies after filing this Pillar 1 country by country reporting, which they have received from multinational enterprises. Now, I move to the minimum corporate tax of 15% for multinational companies. What has happened now today? I want to brief you first to understand what is the minimum 15% corporate tax. If you imagine country one, say example, Ireland taxes at 12.5%. Most of the American companies have moved, like Microsoft, Google, Walmart, most of them have moved their IP rights into Ireland, and all the global businesses are transacted from Ireland. So what is the advantage of that? So what happens is that the American company, instead of paying 30+% of corporate tax in the US, they moved all the IP rights to Ireland. Ireland tax rate is only 12.5%, resulting in the global income that they make, they park it in Ireland or in other countries and pay a corporate tax of 12%. The same way, multinational corporations may go to a jurisdiction where the country's tax is very low and doesn't pay the fair share of tax, even though it originates from one of the countries in Europe, UK, or US, or any parts of the world. In order to avoid that, the OECD has come out with a concept that the multinational enterprises, which was defined very clearly, which I've shown you earlier slides, any company which the turnover is more than 750 million euro, consolidated financial statement is considered as M&E, should pay a fair rate of tax of 15%. Okay. Then I started thinking, when this act was introduced, all the countries in the world are going to bring down the tax rate to 15, which will not happen. Can I tell you why? Because each country operates on their budget. What I mean by budget is each government has got their own capital expenditure to meet. First, the difference between a human being, an individual's income, and a government income is different. I will explain to you. Individual income is determined very clearly. If he's a salaried guy, he gets his 5,000, then he decides what all his expenses. When it comes to a government first total up all the expenses, what all the capital expenses which is committed and which is regularly incurred. So they come out with a figure, say, for example, $100 billion. Then they start calculating how you can raise the revenue of $100 billion to meet the $100 billion of expense. So they come out with direct taxes, indirect taxes. They have income tax, they have property tax, they have goods and service tax or VAT. And then whatever the tax they have, they try to bring in more than $100 billion to meet the committed expenses of $100 billion. This is where the vast difference between individual and the government. So when the government has already decided to have an expenditure of $100 billion, and if Singapore government, say example, put 17% to realize the corporate tax to meet the expenses, they cannot bring down the tax of 17%. Only the multinational corporations are establishing themselves throughout the world. So the person who was to penalize to take the advantage of lower tax, only multinational corporations. So what the Singapore government has done is, in order to go in line with OECD, they have come out with a new act has been come out in Singapore, which is called Multinational Enterprise Minimum Tax Act of 2024. Luckily, the Singapore tax is 17%. The, the minimum tax which OECD is recommending is 15%. It is only for those countries which are charging less than 15% in the 140 member countries. They have to charge a top-up tax to recover the difference of tax. If a country is having, say, 12%, it has to come out with a top-up tax of 3% to make it as 15%. So there is a uniformity of minimum tax is charged in all countries, so the multinational enterprise doesn't take advantage of the situation. I will give you a second scenario. In Singapore, why they have enacted the act? In Singapore, you have got pioneer status companies. You are aware that the pioneer status companies enjoy the tax benefit. They don't pay any tax. Government has introduced 5%. Some of the pioneer companies doesn't pay any tax. They have a tax holiday for 15 years. So if a multinational enterprise is enjoying a pioneer status situation in Singapore, then it has to pay a tax of 15%. That's the reason why the Multinational Enterprise Minimum Tax Act has come in. It's called M&E top-up tax of 15% will come in. The same situation, some companies are enjoying 5%, 10%, 15% concessional rate of tax. So the difference of tax have to be collected from these type of multinational enterprise. Third is some of the multinational enterprises are enjoying global traders program where the tax is also not 17%. It may be 5%, 10%, or 15% based on the letter issued by Enterprise Singapore. So in which situation also a top-up tax will come in to have a uniformity of taxation. So the reason for introduction of the top-up tax is to make good the multinational enterprises pay the same fair share of tax of 15%. You can ask me, there are two terms I've used in the in this particular topic, which is minimum top-up tax, which is multinational enterprise top-up tax, MTT, they call it. The other one is, we talked about DTT. The second one is, sorry, there are two things, domestic top-up tax and minimum top-up tax. Okay, domestic top-up tax is a tax if suppose a multinational corporations have offices in various countries. I was quoting you a 12% country, and headquarters may be in a different country. So the country which has got 12% tax will certainly levy the minimum top-up tax of 3% to make it to 15%. That's what the OECD is looking for. The minimum top-up tax will come into play if the multinational enterprise use Singapore as headquarters. If the country which is charging 12% for the one of the group companies which is situated in that country, if they fail to do or if they don't do the 3% top-up tax, the headquarters will do the 3% tax to fulfill their expectations and requirements of OECD. That is becomes the minimum top-up tax which is being implemented by the OECD. And now I feel you are clear. It is difficult to understand. If you have doubt, you can always question me, or you can come to my room at all times to see that. You can ask for explanation to understand the difference between the domestic top-up tax and minimum top-up tax, which has been introduced globally by various countries. And Singapore has come out with Multinational Enterprises Minimum Tax Act of 2024. This act has come into force from 1/1/25. So the first financial year ends in December 25. Will have the minimum top-up tax, and there are various forms to be filed by the multinational enterprises to satisfy that they have crossed the 750 million euro, equivalent to 1.1 million Singapore dollars, and file the returns based on that as required by the new law enacted in Singapore. I have compared between the domestic top-up tax and minimum top-up tax. Actually, I should thank AI, which has come out with this. I couldn't get this comparison chart anywhere, in any place. I went to ChatGPT and requested ChatGPT to give me a comparison between domestic top-up tax and minimum top-up tax, which has come out beautifully with this beautiful comparison to make you to understand simpler and easier. All the topics are very, very heavy subject. I do not know how I'm carrying on and explaining to all these things to you. It's not easy. You have to concentrate each one. It should be a lifelong learning for everyone. And every day you should have a habit of reading for 1 hour and then start building up your reading habits, make a lifelong learning. Then it will be easy for you to understand the changes that are happening around us. And I want to tell you a very interesting thing. If you are an auditor and carrying out an audit, if you have a fair knowledge or some amount of knowledge or basic knowledge of taxation, some basic knowledge of corporate sectoral practices like setting up of companies, regulations, directors and shareholders, all those information, some proactive thinking and common sense can carry out a better audit. So I encourage all of you to have a reading habit, to read various subjects which are coming up, which is relevant to your audit. Audit is a ocean. Knowing the accounts, knowing the financial accounting standard, going through the financial statements and carrying out an audit, I don't feel you are a complete, the entirely done a fair job of carrying out the audit. You should have the rest of the expectations which I was telling you earlier. If you built up those skills, core skills, which will certainly enable you to do a complete, thorough, good quality audit in your profession. Now I come into the tax incentive scheme for fund and fund managers. 13D talks about funds managed by fund managers. So the tax exemption is given to fund managers. Fund managers doesn't make a big investments because they only charge for managing the funds. So the tax department also want to give a tax concession to fund managers where they get the fees collected from various funds which they have managed during the course of their business, for which the 13D scheme has come into force. 13O and U is already there. It was having a different section numbers. Now it has been renamed. Every 5 years, these sections, these provisions have been extended. So now, during the last budget in 2024, 13O and U is extended for the next 5 years. So the benefits they enjoyed by the fund manager, fund and the VCCs and family offices were enjoying earlier, they continue to enjoy until December 2029. When I was talking about family office set and VCC, I talked about ONU again and again. This is nothing but the same regulations used for companies which, especially the fund managers who manage the fund, which is pooled, or it may be in the form of a VCC, or it may be in the form of a family office. These benefits, tax benefits, are given to the respective fund management fund or VCC or family offices. What is important is that Monetary Authority issues, after making the application, they thoroughly go through all the process and subsequently issue a letter approving the tax exemption with various conditions. You have to read when you do the audit of these type of companies which has got a mass license, you have to read the license issued by the fund managers, sorry, by the Monetary Authority of Singapore. So the letter of approval for tax exemption is issued for the life of the fund, or you can say life of the company which manages the fund. So there is no subsequent letters are issued, but the Monetary Authority will ask you to file the annual returns, in which case they try to find out that the fund is investments are made according to the requirements. Funds are not only invested, managed, and the regulations and conditions laid out in the letter are fulfilled throughout the life of the fund. Another interesting thing is that the auditors have got extra responsibilities and liabilities when carrying out an audit of these either licensed or exempted companies from MAS, where beyond issuing the auditor's report, after you carry out the audit, you have to fulfill the expectations of the Monetary Authority of Singapore. There are various forms to be filed by the company and to be certified by the auditors. I can talk to you about Form 4, which talks about any company which got the license. The auditors have to also provide a certification under Form 4. I will tell you what is the content of Form 4. Basically, the Form 4 will say that the company has complied with all the regulations of the Act, regulations, and all the circulars issued by the Monetary Authority of Singapore in carrying out the most of the regulations and provisions. So auditors have got an additional responsibility beyond carrying out an audit and issuing the audit report. Form 4, in which you have additional responsibilities to inform the Monetary Authority of Singapore that the company has fulfilled all the regulations, Act, circulars issued by the Monetary Authority of Singapore. Whenever they give you the tax exemptions, you also get the GST remission. So US GST is also waived for most of the transaction for those companies which have got the license. Secondly, withholding tax exemption also is provided to these transactions, and also all these things are extended until December 29. For 13O only the 30-50 rule applies. It doesn't apply to 13U. If a fund has got less than 10 investors, who are resident individuals, and if you have a company investor, the company investor should not hold more than 30% of the fund. The intention is that there is a spread of the fund rather than a company holding more than 30% will not fulfill 30-50 rule, then penalty will come in. The same situation happens if a fund has got more than 10 investors. A company cannot own more than 50% of the fund. Again, if 30-50 rule is not complied with, not only you lose the, if the Monetary Authority want to withdraw the license issued for tax exemption, the tax department may come out with penalties for non-compliance also. The asset under management under 13O and U is also defined very clearly. In fact, if you look at 13O and U, for family offices, it needs minimum 20 million, as I was telling you earlier, 10 million at the time of application to the Monetary Authority for getting a tax exemption. And within a period of 2 years, it should fulfill $20 million of asset under management. There is also requirement to have minimum expenditure. Business expenditure is required from these type of companies, and these companies' annual expenditure should be $200,000 based on the size of the fund, and 300,000 and 500,000. Now it is also increased to $1 million if the fund asset under management goes beyond the amount. Before I go to the next topic, I will tell you some more issues concerned with the section 13U, O and U. You also have to require to have investment professionals. Minimum, there should be 2 investment professionals for 13U and minimum investment professionals of 3 people for 13U. Or if it is a family office, out of the 2, one can be a family member, but one should be a non-family member. They should be minimum paid a salary of $3,500, and also the investment professionals are like traders, research analysts, or portfolio. These type of people should have necessary qualifications. They will be disqualified. They will not be accepted as investment professionals by Monetary Authority of Singapore if they don't fulfill the requirements and expectations of Monetary Authority. Now I move on to Section 10L, which talks about, this is a new act which has come in, new sections, new amendment to the Income Tax Act, which talks about gain on sale of foreign asset. But there are, before I go into, is a very narrow section. It only applies to companies which are group companies. Now I'm talking about gain on sale of assets, which is if any company is owning any foreign asset, if it is sold, you think of capital gains tax. But in Singapore, there's no capital gains tax, but they treat it as a revenue income, and it will be subject to tax in the normal course of business. So gain on sale of disposal of an entity of a relevant group of any movable or immovable property situated outside Singapore. Very important in that is sold and the money is received in Singapore, then it is subject to tax. It is received from outside Singapore or treated as income chargeable to tax in Singapore. Secondly, it is very clear that it applies to group companies where they have got assets, liabilities, income, expenses, and cash flow in Singapore. The following, if you try to offset the capital gain by settlement of or remit the money into Singapore, it's subject to tax, or offset it with any debt or purchase of any movable property out of the proceeds, are all considered as deemed as brought to Singapore. If a company possesses adequate economic substance in Singapore, in that case, gains from disposal of foreign assets or sale or disposal are not considered or subject to tax. Actually, the next topic we are going to talk about what is economic benefits. So we will understand what do you mean by economic substance or benefit. Meaning of economic substance or benefit is very clear. I'm not going into the detail. It's a simple matter. That means where nowadays, if you open up the business times, there are a lot of BVI companies have been closed. There are used to be BVI. There are 47 tax havens countries in the world. BVI, Cayman Island, Mauritius, Seychelles, Bahamas, like that. So many small tiny islands were considered as tax haven countries. A lot of people have moved and set up companies in these countries, international companies. Actually, that is the topic itself. I can speak for an hour. I used to speak on tax havens in the world. I'm not going to talk about it today. I just want to brief you that these countries, if you look at BVI, 700,000 companies were incorporated to carry on trading, banking, insurance, finance, and various type of activities, and they were not paying any taxes for the profit made. Those countries are not taxing you because the operations are taking place outside but booked in these countries. So what has happened is today, after the OECD has come with the Pillar 1 and Pillar 2 activities, and they started telling them always look into economic benefits for your country. So today, more than 10 to 15 companies are closed in BVI and shown in the business times. Advertisements appear in business times because of that, because these companies cannot fulfill the economic substance required by the BVI, which has been forced by OECD countries to implement the economic substance requirements. So economic substance requirements, it means that a lot of activities takes place in that country, decisions are made, meetings are made, they have a full-fledged operations, they have an office, which are all there in this various points. Significant strategic business decisions are made to enable you to say that the management control of the company is in that country, in order to say prove that you have economic substance and to get the company's existence in those countries. So this is a new issue. This is also part of the initiative, the 15 principles which OECD has come out with is pillar 1, pillar 2. Economic substance is also one of that. And the last one, you are going to see that also, which is going to come in the subsequent slides. Don't look at Singapore-based service providers, because this is all the rest of the provisions are made in general. Singapore-based service providers is required only for the section 10L. Generally, rest of the sections are there. The rest of the points are made. This was made my mistake. It was Singapore, but this applies only to section 10L, which I was talking about economic substance. Now coming to recent changes in the Singapore Companies Act, Accountants Act, and also I'm going to touch upon the few changes taken place in UK and in India. Singapore Companies Act, section 215 talks about the accounting standard, financial reporting standards, compliance of that. One of the CEO, Miyoshi, was fined 22,500 for not complying the accounting standard for an impairment loss of 16 million, which has not reflected in the financial statement. Immediately, what the issue should prop up in your mind is that what happened to the auditors who have issued the report. Auditors have qualified the accounts, hence the auditors were not taken into task. The ACRA, when they do the annual review of the financial statements which are filed to them, they come out with this company where they have not provided for the impairment loss of $16 million, and hence Mishi was fined 22,400. Coming to the next one is amendment to the Accountants Act. Accountants Act has been amended where ACRA has got the power to inspect the accounting firm's entities office and impose sanctions on other entities to rise the standard in the industry. Also, after the amendment, the penalties have been increased from 50,000 to 150,000 for in the Companies Act, so that the compliance of the accounting standard has become most important today. What is the recent change in the United Kingdom? United Kingdom, there is a change of leadership. The Labour government has taken over. After the Labour government has taken over, they have removed the domicile status. They always call it as global income was not taxed in UK. That's why the rich and wealthy people, high net worth individuals were residing in Singapore. Lakshmi Mittal, the guy who was owning most of the metal industries in the world, more billionaire, is living in the UK. What has happened is for all these residents were not paying tax for the global income. They were only paying $30,000 for the global income pounds. Now that has been removed, means that any income earned abroad will be subject to the regular tax in UK, which has made all these wealthy individuals to leave UK and settle down in other countries like Luxembourg, Dubai, and Singapore. And then I'm going to the next one. Also in UK, the capital gains tax was there for short term and long term, and it has been increased from 10% to 18%. Long term is from 20 to 28%, which is also another reason for the rich people to leave UK and to settle down. I also got the statistical information. More than like 8,000 high net worth individuals are moved out of UK to settle down in some other countries in Europe, like Luxembourg, where there is no global tax. Also moved to Malta. There is one French colony which is most expensive in the world. I'm not getting the name of the country. Moved to Singapore, Hong Kong, and Dubai. The next one is I'm going to India now. There are three topics I've included. One I've not written inside, which I will talk to you. The first one is about audit compulsory for Indian companies, subsidiaries established in Singapore. You are aware, Singapore, we compile the financial statements if the business done or the assets are less than $10 million. Now, but India has issued a circular. If you have taken approval under the ODA route and make investments outside India, if it is in Singapore and other countries, when you file the annual return, you have to file this annual return and submit the financial statements which are audited by overseas auditors. So there is a need has come now to carry out an audit for all the Indian companies established outside India. The next one is poem. This was the topic I used to speak for an hour. Poem is place of effective management, which is also included by OECD, which we talked about earlier. The tax authorities have amended the Section 6. This they have done 3-4 years back, wherein which if the directors sit in India and manage the company in Singapore, they started saying, why can't we say that the management control is in India and not in Singapore? Why we should not tax the Singapore income back in India? So all our clients used to start asking me why we should, how do we come out of the poem? So there are various ways you can come out of the poem. I can brief you on that on a topic which we take it separately on this issue. The next one is this is also a OECD concept where if the transaction is not of commercial substance and commercial value, if you use it for any DTA between two countries, they say that the transaction including investment made may be for tax avoidance. You will not enjoy the DTA benefit. This is the initiative made by OECD. India implements in a bigger way. A lot of clients have consulted me on this topic. What I want to tell you is that if there is no substance, same like what we are talking about, also transaction doesn't have commercial substance, it is done only for tax avoidance, then the DTA will not apply. The next one which I want to talk about is the third point on the India issue is about in the budget which was announced a day before, in which all the non-resident Indians, if they have an account in India, which is called NRO account, you may have an NRE account. You don't have to worry about NRE account. If you have a non-resident ordinary account, NRO account, if monies are deposited into the account, a new regulation has come in this budget, wherein which the tax department has the right to tax all the money banked into the NRO account and treat it as income earned in India. So also they say that as per the new regulations in the budget, you will be subject to deduction of tax at source of 60% for the money deposited into the account. So be careful. If any of your friends want to deposit money in India and want to pick up dollars in Singapore, you are in trouble. Or if they are taking a loan from you in India and want to deposit the money into your NRO account, you are in trouble. Be careful, which I would like to caution you. I was reading about that today, which I thought that I should also bring to your attention. With that note, I don't have any other things to say. Thank you for attending to me patiently and listening to me patiently. If you have any questions, feel free to ask me. I'm happy to answer. If you are afraid to ask questions, you can also come in writing. Thank you for attending. Thank you for listening. Thank you for your patience. Thank you.